Get your money out now. I'm your host, Steve Van Metre, and thanks for joining me today. Investors are waking up to the reality that their accounts are frozen and their money gone. Let's over to Bloomberg, where we picked today's story up with the headline, "It's all gone. FTX bankruptcy has retail traders bracing for losses, as investors withholding on the platform will likely have a long, painful process ahead of Sam Bankman-Fried's filing of Chapter 11 bankruptcy." Now, for those of you who don't understand what's going on here, this guy, the Sam Bankman-Fried, he has been heralded as the next JP Morgan. And in fact, if you remember, JP Morgan used to bail out the US government when it was short of funds a long time ago. Now, the Sam Bankman-Fried has been lending everyone in the crypto space who needs money, and as if he has an unlimited source of funds. Well, it turns out those source of funds, not unlimited, and now he's bankrupt. Let's continue on. FDX US, a separate entity from Sam Bankman-Fried's FTX.com, tweeted Thursday that it was still operational and withdrawals were being processed as normal, even as the rest of the company came crashing down. But one day later, his empire filed for Chapter 11, and FTX US customers were ensnared in a swift financial collapse that has rattled the broader industry, shocked investors, and left retail traders facing a long slog to get any of their money back. And that is a big if they'll get any of it back. And when they do, it could take a very long time. And as we know, that a lot of it will go to the attorneys. Investors with crypto on the FTX platform, who numbered more than 5 million worldwide at the peak, will be closely watching the bankruptcy proceedings for any hope they might be refunded. However, many are resigning themselves to the fact that their holdings may be gone forever, and there's a good reason they're thinking that, because we're going to get into exactly kind of what happened here and why this contagion risk is spreading throughout the industry. And as we've warned people in the past, get your money out, because once these things go illiquid, there's a likely chance that you'll never see it again. FTX customers likely have a frustrating time ahead of them now that the exchange is in bankruptcy protection. Customers of Voyager Digital and Celsius Network, both that we covered on this show, two crypto platforms that went bust early this year, are still mostly locked out of their accounts and unsure of how much money they'll recover, if any. And this turns now to FDX Balance Sheet hack paint dim picture for user recovery. And so users, again, are waking up to the reality now every day that perhaps their money is actually gone and there will be no recovery. Let's dig in why. A breakdown of the balance sheet of Sam Bankman-Fried's exchange shared with investors a day before its bankruptcy filing showed it had nearly $9 billion in liabilities. Now, when you discuss a bank, when you talk about liability, what you're looking at here is effectively customer deposits. So $9 billion in liability assets would mean loans and other assets on hand. Let's take a look. You'll see, didn't have a good position here at all. Through $5.5 billion in less liquid assets and $3.2 billion in illiquid assets, something you never want to hear your bank say, according to sources familiar with the matter who viewed a limited version of the information. Most of the biggest holdings, including lower profile cryptocurrencies, Serum, Solana, and FTT, have since plunged in value. And so you start to get a little bit of a glimpse of actually what the problem here is you see things are going down in value. But what did Sam Bankman-Fried do? Why is money likely gone here? Because what he did is he actually used customer deposits at FTC and lent those to his trading arm, what's just called Alameda Research. Now, what Alameda did is effectively either traded against his customers or was actually speculating on those with those deposits. Now, if you think of this from a bank perspective, why he might do this is because you see all these deposits just sitting there idle on your exchange, on your platform or your bank, and you say, wow, if there was a way I could take advantage of that, because most people just let them sit there. They're not trading them. They're not doing much with them. And so what he did is he lent that money to his trading arm, thinking he could either trade against his customers. And we know throughout history that retail traders actually underperform the market. So that could have been his thought. The other factor is if he could use this customer money and trade it, which he actually was believed to be very good at, and then turn a profit, no one would know the wiser. So you think about it this way. He borrows $100 from his customers, trades it, perhaps turns it into 110. His customers are made whole and he's got a profit. Sounds really good. But of course, what is the problem here is when asset prices go down, all of a sudden the whole scheme blows up because that $100 that he borrowed to trade, let's say he turns it into 50. Well, now all of a sudden he's got a hole to make up. He's got to use his reserves, which presumably now we would guess he has none of, to make the customer whole. And all of a sudden, if you start to see people take withdrawals, what do you find out? That the bank is insolvent. And that's what happened here is he speculated with customers' money and lost. And now people want their money back and they're finding out there isn't any there. But why is this spreading to other companies and across the industry? Well, let's dig a little bit deeper because it starts to get even more interesting from here. As crypto lender BlockFi suspends withdrawals in FTX contagion, it cites a lack of clarity over FTX. Well, what's going on is BlockFi was in the process of moving its assets to FTX for custody, according to a person familiar. The majority of BlockFi's assets had not been moved. The person added, not wanting to be identified, and you think they might want to be identified here because you'd want to make your customers happy knowing, hey, we didn't do that. Your money's still good. So what's going on? Well, let's dig a little bit deeper. The crypto lender had given loans to Alameda Research, the person familiar said, without specifying an amount. The loans are over collateralized with liquid assets, including Robinhood shares. So now I think about this. These loans are backed by the equity value of a company. That's not what you want. You think about the traditional banking system. When a bank gets a deposit, they do one of two things. They either go buy an interest-bearing asset to pay customer a return, which would be a treasury security, or they lend it out. Now, in this case, you're going to lend money out. You're not going to take a speculative amount of risk with it. You're going to vet the borrower. You're going to make sure it's backed by an asset, it's got collateral, and you're going to do everything you can to make sure you get your money back if you're the bank. In this case, you're speculating and backing a loan with an equity share of a company like Robinhood. Man, you can only see how interesting this is. But BlockFi is no longer certain about where the funding for its credit line with FTX US and the collateral for Alameda loans came from, citing concerns that it could have originated with customer funds. So now you start to see just exactly how this problem is. You notice that Alameda borrowed from FTX, which used customer funds, and then took some of that money and lent it out again, meaning that BlockFi may not actually have the money they think they have because the FTX customers may actually have a claim on it. And now all of a sudden you'll find out that's why BlockFi is freezing withdrawals. It doesn't know if its money's good because it doesn't know whose money it's got. And that is a huge problem and why you're seeing this spread around, because who was the lender of last resort in the crypto space for a while? Well, it was FTX. And whose money did he have? Well, maybe yours, but he used customer money. And now you see just how bad this is going to get. The development of BlockFi underscores growing concerns about contagion from toppling of crypto exchange FTX and trading house Alameda Research. Digital asset lenders like BlockFi and Celsius Network, also in bankruptcy, have already been buffeted by the rout in virtual coins over 2022. And now it's spreading even further as Cryptocom.com withdrawals rise after CEO admits a transaction problem. And customers pull funds from Crypto.com over the weekend after the company's chief executive said the cryptocurrency exchange mishandled a roughly 400 million transaction. So what you're seeing here now is customers are starting to panic. They're starting to wonder, what is going on here? Is my money good? And what will happen is that will start to lead people either to pulling their money out or selling their cryptos on the exchanges, and that will further drive prices down and put stress on the system. Because when you understand how all these schemes work, whoever it is, wherever they're being run, as long as prices rise, it works. It's the moment prices come down that the whole system starts to break. And that's what you're seeing here is customers are realizing their money may not be good at all. Crypto.com CEO Chris Mozartek said on Twitter that the transfer was sent to the wrong type of account on another exchange. Talk about a major gaffe. The transfer of a large chunk of Ether, a popular cryptocurrency, took place on October 21st, but came to light after Twitter users flagged the transfer as unusual based on publicly available blockchain records. The CEO at the largest peer, Binance, appeared to question the nature of the transfers without naming the company, which may have fueled Sunday's withdrawals, according to experts on the inside. If an exchange has to move a large amount of crypto before or after they demonstrate their wallet addresses, it's a clear sign of problems. Again, potentially more problems that consumers are unaware of that are only going to make themselves known in the days, weeks, and months to come. A spokesman for Crypto.com said the platform was seeing higher levels of activity, noting that it had assets fully matching customer deposits, as fluctuation in deposit and withdrawal activity does not affect our level of service. But again, that's what people thought about FTX just days ago, and then they found out the opposite, and this will put a big question mark on a lot of firms. Maybe they are legit, maybe they do have assets to match the liabilities, but customers are going to start to worry, and we'll find out just who the real players are. And of course, as we know, this will eventually lead to more regulation. With the headline, FTX debacle shows the need for crypto regulation, says former Fed chair and now Treasury chief Janet Yellen. In other regulated exchanges, you would have segregation of customer assets, noting that this is a big problem that regulation would have solved. The notion you could use a deposit of customers of an exchange and lend them to a separate enterprise you control to do leverage risky investments, well, that wouldn't be something that's allowed at all. And at least it's not deeply integrated with our banking sector at this point and doesn't pose broader threats to financial stability. And of course, so far, we're seeing the risk contained inside the crypto space, but that's just because we don't know yet who else FTX lent to or who else everybody was invested in. And over time, we'll start to find out. We'll see if the banking system can hold up against this, and it likely can, but who knows what this could mean for the crypto space. But Binance is set to create a recovery fund for crypto projects short on cash. Notably, it says projects. Of course, the cryptocurrency exchange, Binance, is positioning itself as a stabilizer in digital assets following the collapse of its rival, FTX. The chief executive Zhao said on Twitter on Monday that Binance is forming a recovery fund to help strong cryptocurrency projects, key word being strong, that are facing temporary cash shortages. He did not disclose the details of the fund, saying that it would be coming in the future, again, starting perhaps the realization that what's going on here isn't good for business. But the problem stems from one thing and one thing only. As I mentioned earlier, as long as prices are rising, every type of these schemes and throughout history, they could all work. But here you can see in a simple chart of Bitcoin over the last year, the price is going down. And this is where you start to root out all the leverage, loans, and all the things that were keyed on the price rising start to get flushed out. And that's why I said, you find out who the real players are, they'll be the survivors, but there'll be a lot of collateral damage along the way. There'll be a lot of frozen accounts and money perhaps even lost. But what does this mean from the Fed's perspective? Were they the cause of this? Well, not at all, but they're going to continue on their path as if nothing here is even impacting their view. As Fed's Waller said over the weekend, there's a ways to go before rate hikes are done. And while officials could moderate the size of the rate hikes to 50 basis points at their next meeting, or the one after that, after a string of 75 basis points moves, Waller cautioned that officials were not close to a pause at all. These rates are going to stay, they're going to keep going up, and they're going to stay high for a while until we see this inflation get down closer to our target. We've still got a ways to go, and this isn't ending in the next meeting or two, and this was likely a reaction to the stock market going up after the CPI print. But for those in the crypto space who are worried about their money, with interest rates remaining high and the Fed backstopping money markets, could give people a place to go as a safe haven. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.